Hello. Excellent. Thank you very much for joining me, Fiona Cincotta, Senior Market Analyst here at City Index, as we look ahead to the trading week of January the 20th, 2025, a very important week with the inauguration of President-elect Donald Trump. But before we get going on that, I'm just going to ask you to have a quick read of the risk warning. I'll put myself on mute whilst you take your time to digest what it is. Okay, excellent. So let's kick things off. And I think we're just going to start by having a quick look at the charts, particularly that of the 10-year Treasury yields in the US. A lot of focus this week has been on Treasury yields as they rose to very elevated levels before quickly falling sharply lower. Now, this is all to do with the inflationary outlook. We obviously had expectations regarding inflation in the US building across the start of the week. That was after that really strong jobs report that we saw at the end of last week, just fueling inflationary expectations ahead of obviously President Trump coming into power with his expected inflationary measures such as tax reductions and trade tariffs. But data this week from the US has been more calming and soothing as far as expectations surrounding Fed rate cuts are concerned. And with regards to inflation, we saw US core inflation, so underlying inflation, actually unexpectedly fall, which is really helped to calm those concerns regarding inflation and inflation worries. That big sort of drop there. We saw the bearish engulfing candle there on the yields chart. Following the inflation data, we also saw slightly weaker than expected retail sales and also slightly higher than expected jobless claims. So all that combined has helped to just assess the market's outlook for inflation and Treasury yields. That has obviously had the impact this week that we saw the US dollar come off that multi-year high of 110.17, currently trading just below the 109 level. So we've seen the US dollar come off. It's still trading within that rising channel within which it's been trading since the end of September. And then as far as what this all means for US equities market, we've seen a recovery in equities as those Treasury yields have eased from those highs, and we sort of helped that recovery in the stock market. Here we can see on Wednesday, on that same day, that the Treasury yields slipped sharply and we had that weaker underlying inflation. We also saw US stock markets jump particularly higher. That sort of falling yields or weaker US dollar has really helped sentiment as we head towards the start of the new week. However, big caveat, what happens next is going to depend very much on what President Trump has in store for us when he takes office on Monday. His inauguration is on Monday. And so I think we're expecting to see sort of a little bit of caution ahead of his move into power. But to be fair, we haven't really seen it in Europe. I mean, the US hasn't opened yet. But we've got, European stocks trading at all-time highs. So not necessarily a huge amount of caution in there. We are seeing it a little bit more in the US, where we've got stocks trading down from their all-time highs by a reasonable margin. But basically, what the market's going to be watching out for is what measures will President Trump be bringing in immediately. I mean, some of these measures have sort of semi-priced in, and some could sort of bring more volatility. The market's going to be particularly focused on any immediate measures surrounding tax cuts and trade tariffs. These are the ones that could potentially impact the inflationary outlook for the US. Obviously, they could also impact the outlook for other parts of the global economy, such as China, Europe, Canada, and Mexico. So, you know, what we hear from Trump can move the market. We know that this week, you know, there have been quite a few reports over the past few weeks over how aggressive Trump will bring in trade tariffs, how aggressively they will be. When we've heard sort of news that they'll be less aggressive, we've seen risk sentiment, equity demand really bounce. On news that, but actually they could be on reports that they could be more aggressive, has had a negative effect. So broadly speaking, what I'll be watching for is if we hear news of immediate tariffs, that will obviously be watching the economies that they're related to. So for example, China, Europe, Canada, Mexico, we could see big moves in their currencies and stock markets, depending on what is announced. Same for the US dollar. If the US dollar is, if the incoming immediate measures are considered inflationary, that could really change the outlook for the Federal Reserve's rate cuts this year. At the start of this week, the market was just trading in, so following that really strong US non-farm payroll report, the market was pricing in just one potential rate cut, and that was going to be all the way in December. Now, given that December is a long way off and anything can happen between now and then, it was almost as if the market was saying they don't see the Fed cutting rates. Since we've had this weaker data, I mean, it's not massively weaker, but it's just managed to change the stance a little bit of the market. Then we have seen that the market has actually increased rate cut expectations across this year and are now pricing in at roughly evenly 2 rate cuts, one in potentially June and another at the end of the year. So that's what I'm going to be starting with here. Watch out for comments from Trump. We know how quickly he can move the market, particularly now that he will be in power and can take actions and can take actions quickly. If we just need to think back to his first stint in office, and you know, his tweets could move the market really quite considerably. So that's what we need to be watching out for. Potentially, if he comes in with a softer stance, that's going to be really bullish for stocks potentially, because that will see the market you know, just soothe some of those concerns over inflationary measures and help lift Fed rate cuts. This is the S&P 500. We've seen a recovery from that lower 57.70. It's taken out this support zone here that we've seen around the 58.50 level. Just looking to move now. Next move higher will be above the 50 SMA, around the 59 sort of 50 level, sorry, 59.70 level. If we can get above there and 6,000, then we'll be working our way back up to that 6,000. I mean, the RSI is a little bit more neutral. We're sort of seeing a neutral, it's back within this holding pattern that it's broadly been in for a couple of months now. Just really waiting to see what comes next as far as the Fed is concerned and as far as rate cuts are concerned. I think whilst we're talking about Fed and rate cuts and what's going on there, it's also worth having a look at the US gold, denominated gold, because here again, we've seen quite an interesting move higher in gold from the December lows of 25.83. Now, interestingly, gold was moving higher, even as the US dollar was moving higher, even as treasury yields were moving higher. So there are a couple of fundamental points, I think, that we can see here. And also gold has continued to move higher, even as rate cut expectations have eased slightly. So we've got a couple of, as I said, sort of contributing factors. So gold is considered a hedge against inflation. So gold has been rising. I think, you know, when we saw treasury yields rise, when we saw the US dollar rise, when we saw gold rise, that's because it's rising as a hedge against inflation. However, if we see gold rising whilst treasury yields fall and the US dollar eases, then that's a sign that gold is rising on reduced opportunity cost of holding a non-yielding product. So gold doesn't yield, it doesn't give a yield, and therefore when expectations surrounding Fed rate cuts increase, then that helps gold. It increases its demand. Obviously, when we see the US dollar ease slightly, that also does favor gold because it's priced in US dollars, so it makes it cheaper for buyers of non-US dollars. Now, that's what we've seen so far. Things to be watching out for next week. We're above the 2700 level. If we get a sense of uncertainty, increased safe haven flows, we could also see gold continue to rise. So there are really a lot of moving parts as far as gold is concerned, because you have that safe haven demand, because you have that inflation hedge, and because you have the prospect of stronger gold if Fed rate cuts expectations rise as well. So lots of moving parts to be watching out for. As far as technically are concerned, we're just looking to rise above. This is a trend line that goes all the way back to October, here we go, 2023. So it goes back to, I think, February 2024. So a year-long rising trend line. We are attempting to rise back above that trend line. Now we've already risen above the falling trend line. Next level to be watching on the upside, 2750, before we get to 2790 and fresh all-time highs. Support we can be seeing here around the 2790 level. That was the 2685, sorry, the high that we saw in September. And then you've got these trend lines to also keep in mind, as well as the 100 SMA. The 100 SMA is another one that it's been trading about really since, back in the beginning of last year. So that again could be another support to be watching closely, 2640. So next we're going to talk about China. So we've had some encouraging data from China, which is today. GDP figures of 5.4% year on year, up from 4.6%. So that's marking the highest level of growth for the year and the fastest year on year growth for any quarter since the second quarter of 2023. This week, the economic calendar in China is quieter. Do have the loan prime rates, which will be announced on Monday, although no change is expected after the People's Bank of China kept the benchmark rates unchanged. Let's just have a look at what's going on with the Hang Seng. As I said, again, obviously it's a quiet week for data, but I think the big movement here will depend very much on what we hear from Trump. If we just have a look at where this is trading, quite interesting, caught between the 200 SMA. It recovered off the 200 SMA at the beginning of the week, and it's just testing the 100 SMA as we head towards the weekend. That's around the 19,700 level, and we've also got that falling trend line. So if we could get a break above that, that would be an encouraging sign, but we'd really need a rise above the 20,200 level to create a higher high. On the downside, the 200 SMA is going to be key there around the 18,700 level. And if we get a break below 18,650, that's going to create a lower low and extend that downward trend that we've seen, bringing this rising trend line dating back to the start of last year into focus around the 17,900 level. So as far as other data to be watching, let's just have a look at the calendar here. This is the calendar on the website, which I've set for next week, and just the most important events. We've got UK data as well. Now, this week has been a big week for UK data. Next week, we'll be having a look at the health of the labour market, particularly. Now, the UK unemployment was at 4.3% in the 3 months to November. So average earnings were around 5.2%, which is still elevated, and we could see some weakness as we move across 2025. Unemployment is expected to rise to around 4.6% at the end of the year. Now, it's worth bearing in mind here that the unemployment rate is quite lagging. It's quite lagging in the sense that this is November's data that we're getting now. So that's just after the budget from the Labour market, from the new Labour government. So we're not really expecting necessarily for that to have had a big impact in the November reading, but it could start to have an impact on unemployment as we head across this year, which is what is expected to happen. In fact, a recent study has shown like a dramatic collapse in optimism among the chief financial officers. According to this is the latest Deloitte survey on business confidence, has slumped to its lowest since the COVID pandemic. Now this is on the back of Rachel Reeves' her national insurance hike in contributions from businesses, which has basically left them scrabbling to cover costs. So as a result, hiring intentions have nosedived to a 4-year low, and employment expectations are at the weakest since the pandemic of early 2020. So that's the outlook. That the outlook for the UK economy is pretty weak. So I mean, can you hear me? I'm just sorry. I'm just wondering whether you guys can hear me properly. There we go. That's probably better. So the outlook is pretty weak, and that means that we're not seeing that yet priced into the data. So the data is not coming through yet showing that weakness, but we're expecting it to happen as we move into 2025. So the data that we're going to see this week also comes on the back of a series of weaker than expected data this week. We've seen UK inflation unexpectedly cooled to 2.5%, which will be welcomed by the Bank of England. We saw service sector, actually inflation in the service sector dropped really quite sharply to 4.4%. So maybe we're going to see some weakening in wage growth as well, because service sector inflation is intrinsically linked to wage growth. We also saw UK GDP was weaker than expected, as were retail sales, and this basically has helped lift Bank of England rate cut expectations. Beginning of this week, the market was pricing in less than one rate cut this year of 25 basis points. Now the market's pricing in around 2.5% rate cut, 25 basis point rate cuts. Now, interestingly, we've seen the pound, obviously it tumbled at the start of the week, and that was because of this concerns over the outlook, the fiscal outlook for the UK, rising borrowing costs as part of a global bond route, but also as a result of the Labour government's budget. The cooling inflation data in the UK as well just helped ease those concerns. So it helped gilt yields fall, which has actually mean that the pound has lifted off its recent lows despite the weaker data. So I think it's fair to say the outlook for the UK remains particularly gloomy. We get sort of more weak data. We've also got UK PMIs next week, so that weak data could further fuel Bank of England rate cut expectations, which could, particularly if we see aggressive sort of policies from Trump, or at least hints towards aggressive policies from Trump, could pull pound US dollar a bit lower. It trades within a falling channel, trading in since the end of September. The low on the downside to be watching out for is 21.40, but that is a hammer candle that we're looking at there, so that can be considered, that could be a bullish reversal pattern. If we're looking for a rise in the upside, we need to get above 123. Above 123, 125 comes into focus. On the downside, below that 121.50 level, sorry, 121 level that we saw, below that opens the door to 120.50 and 120, the psychological level. Also, just going to be having a look here. This is the FTSE 100, because this is interesting. We're seeing that as the pound weakens, we're seeing a surge in the UK index, trading at fresh all-time highs on optimism that the Bank of England will be cutting interest rates a little bit more than first expected. and also on optimism following the upbeat Chinese data. So that's helping the FTSE. Next level to be watching for on the upside will be 86. Obviously, we're just moving into overbought territory here, and previously when in overbought territory, we have seen a reaction for the price to ease lower. So that's just something to be watching out for. Just on the downside, sorry, yeah, we've got several layers of support here. 80, here we go, 8400 and then 8325. That's sort of this range that it's been trading in across the past 9 months. So let's look, what else have we got going on? We've got Canada, okay. So again, Canada is going to be very much at the whim of President Trump. We do have Canadian inflation data. It is to 1.9% in November, and that was down from 2% in October. And Canadian inflation is expected to remain well within the Bank of Canada's target 1 to 3% range over the coming months and quarters, averaging at 1.2% this year. Now, the data comes ahead of the Bank of Canada's interest rate decision at the end of January, where the central bank is widely expected to cut rates by 25 basis points to 3%. Now, the Bank of Canada has been one of the most aggressive in reducing rates. Its rates have gone down in Canada by 1.75% since June 2024, and it's very close to its neutral rate, a rate which neither restricts or stimulates the economy. Now, what happens next, though, depends very much with what happens with President Trump. Obviously, he's been threatening slapping tariffs as high as 25% on Canada imports, so it makes it quite difficult to project beyond here. So next week could provide some more clarity when Trump takes office. If Canada gets hit with large tariffs and doesn't retaliate, then disinflationary impact could prompt considerable more easing from the central bank, and that would potentially see some further weakening in the Canadian dollar. As we can see, it trades within a rising channel here. We're just seeing a bit more of a holding pattern, capped on the downside by 143, on the upside by around the 144.670 level. So we're going to be looking for a breakout trade here. If we get a rise above that 144.70, that's going to create a higher high. We could see prices then move up towards 146 level, the top of the rising channel. On the downside, we need a break below 143 to create a lower low. That obviously then brings 142 into focus, the round number, which is also the 50 SMA. So moving quickly on to the Bank of Japan interest rate decision. Bank of Japan interest rate decision is expected to be a highlight. It will be held on the 24th of January. And basically, I mean, recent inflation and wage data has been encouraging and supports the decision to actually lift interest rates at this meeting. So it may do it. I mean, the Bank of Japan has been known for its element of surprise, but the latest comments from Bank of Japan officials have shown an increased confidence in sustainable wage growth and inflation. But we've also got to watch closely Trump's inauguration. Obviously, that could deliver a negative impact to global economy and Japanese economy. We've also got data from Japan, including machinery orders next week, and inflation is actually on the day of the policy announcement. So inflation is expected to increase sharply in December as the government ends its energy subsidy program. Now, if we do see a rate hike from the Bank of Japan, then that could strengthen the yen further. Here we see, this is a very similar picture to what we saw on the US Treasury yields, reached a peak, and then we've seen it falling off as the US dollar has weakened and also the yen has strengthened on optimism of rate hike. As far as levels to be watching, we're testing the 155 level at the moment. Now below here, we've got this trend line support, which dates back to think it's 2022, this one. Yeah, it goes all the way back to around here, 2022. So that's going to be quite a key level to be watching, whether we get a break below that or not. That level, I'll tell you now, is at around 154. So if we get a break below 154, then we expose the 200 SMA there at 152.85. Quite a few fib levels to be watching. We've got here the confluence of the fib level with the 100 SMA at the 150 and also psychological level. So a couple of key levels to be keeping in mind. But obviously we've also got the US dollar story to be considering and what that sort of means for the economy. And obviously the yen is also a safe haven, so you know, if there are aggressive sounds from Trump's camp, then that could actually give the Japanese yen some strength as well. Oh gosh, lots to get on with. Eurozone PMIs. Okay, so we've got Eurozone PMI. Eurozone PMIs have been pointing to or highlighting the weakness in the Eurozone economy. Finishing last year, so the December, was the composite PMI was in contraction. Manufacturing was particularly weak, although services started to show some modest gains. Now that is the outlook for the Eurozone economy is weak basically, but it also hinges now from what to expect from Trump. Could we expect aggressive trade tariffs, in which case growth will likely slow in the Eurozone and disinflationary pressures rise? Now, this week, the ECB told us in the meeting minutes that they see inflation cooling faster than expected to the 2% target. So that has sort of kept the ECB rate cut expectations very much alive and kicking, which is keeping pressure on the euro-US dollar, particularly when we consider the divergence between the aggressive ECB rate cuts and the not so aggressive at all Fed cuts that could be expected. If we do get aggressive tariffs from Trump, or at least hinting towards that, then that could have a negative effect on the euro-US dollar. It does potentially bring parity back into focus for this year. The low we'll be watching out for is 101.77, but look at that long lower wick. So that does suggest that there's not that much selling demand at those lower levels. We're seeing the price just hover around that 103 level. So we'd need to get some further disappointing data and aggressive tariff news in order for the euro-US dollar to weaken much further. Less aggressive stance, maybe we could see it retake that 103 level, heading towards 104, and 104.70 on the upside would be an encouraging level to cross. But interestingly, the DAX is trading at all-time highs. This is obviously on ECB rate cut expectations. We're seeing this solid rally from August on hopes that the ECB will continue cutting rates, supporting businesses. Strong data from Germany has obviously helped, but if we get tariffs and aggressive tariffs, that's not going to be encouraging news, and we could see that sharply retest the 20,500 level. Now, just quickly moving on, because we've got earnings in the US is continuing. Now we had a solid start to Q4 earnings with the banks that have really outperformed and done well. Encouraging start, as I said, hasn't necessarily been reflected. I know this is the NASDAQ, which doesn't have banks on it, but I'm just bringing this up because we also have earnings this week from Netflix. Now, this is obviously the first of the tech stocks. The rest of the tech don't come for another few weeks, but the NASDAQ isn't performing quite as well as the S&P 500, obviously because it doesn't have that banking stock in it, which has helped to lift gains this week. But the levels on the upside, we're looking out for 21,625. We get a rise above there because we are encouraged by Trump's initial immediate outlooks and policies, then that could be the level to watch on the upside. Just as far as Netflix is concerned, Netflix are going to be earning on January the 21st, they'll release after the close. We're expecting EPS of 4.23, That's basically a 69% rise from the same period last year, whilst revenue is expected to increase by 3.5% annually to 10.11 billion. I mean, the numbers basically we've seen come as we've seen sort of, you know, the share prices trading just shy of all-time highs. And we've seen these sort of strong drive and expectations on successful content releases and basically the growing positive impact of these tier advertising and password crackdown that Netflix have had. As far as subscriber growth is concerned, we're expecting Q3, so the previous quarter's subscriber growth was 5.1 million, paving the way basically for another strong quarter this quarter, which could even double given that we've got content now including live NFL games and also the Squid Game season 2. But it's going to be the last time that Netflix reports subscriber metrics, as it signals a shift towards emphasizing financial performance rather than subscriber numbers. Operating margins guidance is at 27%, so for 2024, thanks, and is expected to increase to 28% next year, thanks to content investment being balanced against cost management. Now, this was the last earnings there. We saw it rally then to all-time highs. Can we see a similar performance? The rise above 868, that's the 50 SMA. It's going to be key to getting the price back up to its record high of just around $940 the share. Now, just quickly, we're going over, but I'm just going to do oil, because oil has broken out. We've seen this strong rise in oil prices. This has been a result of upbeat China data, sanctions on Russia. Will we be getting further sanctions on Russia from the Trump administration? We had them on from Biden administration last Friday, which helped this rise, this rally up here. We've also seen a larger than expected draw on US stockpiles, and so that's basically the main drivers that we've seen in oil prices that spiked it. Oh, and also just a slight improvement on Fed rate cut expectations. 80.50, that's the level we're watching up on the upside, just the 80 round number. We're currently around that 78 resistance zone, support zone. On the downside, obviously, we've got the ceasefire in Gaza, which is just seeing the risk premium fade, but that doesn't seem to have had too much of an impact on the price, actually. So as long as this support resistance level holds here around the 78 level, then we've got this falling trend line at 78 and the 200 SMA at 75. They're the levels to be watching on the downside. Rise above 80 brings 85. That was the level that we saw back in July into focus. Excellent. So I hope you've enjoyed everything that you've watched today and it's been useful for you. And I look forward to meeting with you again next week.